All right, hello everyone. We are starting on page 194 today. We are in chapter 9. Section 2 is where it is. Section 2 actually starts on page 191, but there aren't blanks there. I'm going to leave that for you to read through. It's not heavy reading at all, but just some terms and things that you're going to want to be familiar with when it comes to auto insurance. And we have some activities about auto insurance this week as well, so you'll see that reinforced there. But for the purposes of this video, we're going to start on page 194, kind of in the middle there of section 2. And it's on homeowners and renters insurance. And so it says homeowners insurance should be, quote, guaranteed replacement cost. That's your blank replacement instead of extended replacement cost. And so the difference there, obviously, guaranteed replacement is a guaranteed full restoration in the event of a disaster or anything that would do damage to your home, fire, flooding, etc. But extended replacement cost is reimbursement for a certain percentage of the cost of damages, typically 10 to 25%. And so the emphasis here is that you would want to go toward the guaranteed replacement cost. When you are ready to move out of your parents' house, you need to have renter's insurance. Because most people, when they move out of their parents' house, they end up renting, in the beginning at least, which covers the contents of the renter's apartment in the event of firestorm or theft. So renter's insurance essentially does the same thing that homeowner's insurance does, except it's for renters. And it covers the contents of the house, furniture, valuables, etc. Next, umbrella liability policies are a good buy once you have some assets. An umbrella policy gives you additional liability protection above your other policies. So it's kind of like, think of an umbrella, obviously, kind of just overarches and extends to other assets and things that a standard policy may not cover. And then we looked on page 195, and we see health insurance. And kind of just a misconception there in that paragraph. You may think that because you are young and healthy that health insurance isn't necessary. Everyone needs to have health insurance. Medical emergencies due to injury or illness can occur to anyone at any time. And with the ever-rising cost of healthcare, you need to be prepared. Obviously, with what's going on now with the virus, I think that's true now more than ever. And so you never know. So just some tips here, saving on health insurance premiums. Premium is just what you pay each month for your policy, for your coverage. It says, just like with auto insurance, staying on your parents' health insurance policy until you're out of school and on your own will lower your costs. So typically it could be until age 18. I think a lot of policies for children or minors are extended to that age. But whatever that is, stay on it as long as you can, because obviously that saves you money, and you're receiving health coverage, health benefits that don't come out of your pocket. And so it says here, save on your health insurance premium. So when it comes time to get health insurance on your own, number one, increase your deductible. Deductible is the blank, and or co-insurance amount. Deductible being that amount that you are responsible for before the insurance actually kicks in. Number two, increase your stop loss, but never decrease your maximum pay. So what is stop loss? It is your maximum out-of-pocket expense. And so that's ideally one of the reasons why we have and teach an emergency fund. The stronger your emergency fund is, the higher you're able to increase your stop loss. In other words, you're able to pay more out of pocket. Therefore, your premiums each month, your payments will be lower. So that's kind of how it works, right? The higher the premium, the lower the deductible. The lower the deductible, the higher the premium. And so just make sure that you understand that's one of the reasons why we do emphasize an emergency fund, because if you're able to sustain a $5,000 hospital bill, for example, and be fine, then you may not have to pay as much per month. Okay. Next, see if an HSA, so a health savings account, the blank is HSA, the acronym there, would make sense for your situation. What is an HSA? It is a tax-sheltered, that is your next blank, it is a tax-sheltered savings account for medical expenses that works with a high deductible insurance policy. So basically, pre-tax dollars, or excuse me, dollars that have already been taxed go into that. You fund the HSA with money that's already been taxed, obviously, because it's your income, and that builds up, and that kind of is like it's what it says, a health savings account. It's like an emergency fund, if you will, for health insurance, and certain people qualify for that, certain people don't, but that is a very good option for you to use if you're able to when you need to, because oftentimes it'll also roll over. It doesn't expire in a calendar year or deductible year, and it'll roll over to the next year, and you can just keep putting money into that, and as you're healthy, you keep funding that, and it grows. So when you need it for something goes wrong, or an illness, emergency, break a leg, whatever, then you have plenty of money in there to help with that. And then page 196 goes through some of the basic components of health insurance. Again, I'm just like with the auto insurance at the beginning of the section, I'm going to leave that to you. So please make sure you read those. It does talk about some important things about co-payments, deductibles, dental eye insurance it mentions. So just a few things there that you are going to want to be aware of and make sure you know. Page 197 talks about long-term care insurance, and that is it's something that you need if you can no longer perform everyday tasks by yourself. Typically, this is for senior citizens, something people really need to look at once they get older. So not necessarily our situation here, but just so you're aware of what's available. Causes may be chronic illness, injury, disability of advanced age. Your odds of needing this level of care increase as you get older. So what is long-term care? In long-term care insurance is for nursing homes, assisted living facilities, or in-home care. So at some point when you get to that stage when you need that, having funding for that or insurance for that is going to be critical at that point. A long-term care policy will include in-home care. You should not buy long-term care insurance until age 60. So again, this is not something that we need to look at right now, but just be aware of it. It really would be a waste right now because, I mean, you would not qualify, or I should say need these types of benefits. The probability of a nursing home stay before age 60 is almost zero. So again, it doesn't make good financial sense to invest into something like that at this point. At least 69% of people over the age of 65 will require long-term care at some point. Long-term care insurance is not the same as disability or short-term medical care. So there is a difference there. And as we flip the page to 198, we see a little bit of what those differences are when we talk about disability insurance. Disability insurance is designed to replace income, that's your blank income, that is lost due to a short-term or permanent disability. It basically provides an income for you if you have an accident or health condition that prevents you from working. Once you are working full-time to support yourself, you will need to have disability coverage. So try to buy disability insurance that pays if you cannot perform the job that you were trained, is your blank, or educated to do. And that is called occupational or own-oc disability. Many times this is only available for 2 years. So occupational. That will specifically cover you if the disability prevents you from doing the job you were trained to do. Now, so there's a difference between long-term care and short-term care. Beware of short-term policies, that's your next blank. Beware of short-term policies covering less than 5 years. Essentially, again, back to the emergency fund. If you have an emergency fund, it's funded, you're good to go. With that, then a short-term policy is not necessary because you should have enough in there, also staying out of debt, having a good money plan, working on a zero-based budget to be able to fund 6 months, a year, maybe 2 years, I don't know, of income replacement should something happen. And so if you have an option of doing short-term or long-term, what you always will, you want to go for that, that long-term, because that is what will cover you for 15 years, 20 years down the road, and that will replace, I think, up to maybe 65% of your income, and you're not even working. So you can choose to have that insurance and have up to 65% of your income coming in every month, even though you're just disabled, or not have that insurance, not pay into it, and it's really not that expensive when you start earlier, and not pay into it, and then something happens and you're not able to work and you have absolutely no income coming in. So that is strongly recommended. Your coverage should be for, as I mentioned, 65% of your current income. The elimination period is the time between the disabling event and when the payments actually begin. A longer elimination period will lower your premium cost. So I think you can choose between, I think it's 3 months, 6 months, maybe. And there could be more. But the longer the elimination period, the cheaper it costs. So let's say something happens to me, I'm unable to work, but I say my elimination period can be 6 months or 8 months or whatever. The longer that is, the less I pay. So I could wait 6 months before getting any money from that insurance. That's what I'm saying. And then finally on page 199, identity theft protection. Don't buy identity theft protection that only provides credit report monitoring. That's what most banks and credit card companies do. They offer credit report identity theft protection, but it's only monitoring. Credit report monitoring is something that you can and should do yourself. 3 times a year, you can get your credit report from the 3 business bureaus, Experian, Equifax, and TransUnion, I believe it is. And you can get it to monitor that yourself. You don't need to pay someone to do that for you. Good protection includes restoration, that's the blank, restoration services that assign a counselor to clean up the mess. So basically, you're doing less of the work. Someone steals your identity. There's a data breach at Target or Walmart or whatever, and you're not responsible for that. And that could take months and months and even years and headaches and paperwork and phone calls and all this stuff. But you're paying someone, and again, it's not that expensive. I have it. You're paying someone, that insurance, it goes right to them. They do that. That counselor, that representative covers all that work, and they do that and restore your finances or your credit, everything damaged back to what is normal and what it should be. So there are those types of insurance there that you see in section 2. So we're going to continue this week and next week looking at more of these. There's 7, I believe, in total that we're looking at. So hopefully you're getting a better idea of some of these options that are available to you, and ideally take advantage of when you're able to. All right. Thanks, guys, and I look forward to talking with you soon.